Afternoon, and thanks for joining us for this webinar as we take a moment to look back at notable developments in the BDC industry this year and look ahead to key regulatory trends for BDCs as we head into 2023. For those who don't know me, I'm Steve Bohm, a partner here at Eversheds Sutherland and head of our capital markets and investments practice group. It's been quite a year for BDCs as the industry welcomed 21 new members, and BDCs now have over $267 billion in assets under management. And here at Eversheds, we helped our clients raise over $7 billion this year through various capital raising transactions. We also recently welcomed a new partner to our practice, Eric Simonek, who brings us deep regulatory compliance experience with exchange traded funds and commodity pool products. Today, I'm joined by my co-host, executive partner Cynthia Cruz, as well as several partners in our capital markets group, Cindy B.A., Kristen Burns, Dwayne Dupree, Stephanie Hildebrandt, Ann Oberndorf, Owen Pinkerton, and Payam Siadatpour. Some housekeeping for today's webinar. Please feel free to use the Q&A functionality in Zoom to submit questions for any of our presenters. We'll try to address as many questions as we can throughout the session. This webinar will also be recorded, and you will receive a link to the recording following the session. Before we dive into today's conversation, I'm going to turn it over to my co-host Cynthia to say a few words.
Thanks for joining us here today. At the top of this discussion, I wanted to talk a little bit about some of the recent changes in the leadership at the SEC. This fall, the SEC named Caitlin Babcock and Thoreau Bartman co-chief counsels of the Division of Investment Management. As you know, the Division of Investment Management oversees the regulatory policy for advisors, investment companies, mutual funds, closed-end funds, and BDCs. Ms. Babcock previously served as the branch chief and senior counsel in the chief counsel's office of the division, and Mr. Bartman previously served as assistant chief counsel for investment management and senior counsel, special counsel for investment advisors and rulemaking. So we hope that having those two resources in place will help us get some more answers. In addition, one of the things to note is that as the Congress changes over, you've seen some discussions in the media about having Gensler come in and talk to Congress, what will happen as a result of that, and the rulemaking, since there's been quite a bit of rulemaking that we'll talk about over the course of the day, uncertain on what the timing will be there. However, we will be meeting again in April. I think that everybody has already received a save the date for the 2023 BDC Roundtable. Will be April 11th and 12th in DC. Registration will launch in about a month or so, and we will be celebrating our 20th anniversary of this event. So join us to find out kind of where we end up with the rulemaking. But for today, Steve.
Thanks, Cynthia. I'm going to kick us off by bringing Payam on to talk to us about capital raising in the current environment. Payam, the economy is on everyone's mind today with inflation on the rise, notwithstanding the news yesterday, VC funding drying up, and fears of a recession brewing. How are BDCs faring in this economic environment and raising capital?
I think BDCs are generally doing very well. Portfolio performance remains strong, as reflected in the valuations we see in the 10Qs and Ks every quarter, and also evidenced by the steady distributions that BDC continue to pay investors. In particular, those BDCs with a focus on floating rate loans have benefited with interest rates increasing with better earnings. Now, of course, that does put downward pressure on credit quality with the chance of defaults increasing. But as I said, from what we're seeing, credit quality across the board is relatively steady. With respect to capital raising, 2022 was another solid year for BDCs. In the second half of 2021 and early 2022, we completed a lot of bond offerings at really historically low pricing. They were pricing at between 3 and 5%, and in a couple of instances, even below 3%. Now, as 2022 went on and interest rates rose, obviously the cost of capital increased. And towards the middle and third quarter of 2022, we saw a number of bond deals priced at between 5 and 7.5%. And most recently, over the past couple of weeks, with actually one bond offering closing just this morning, we saw deals get done at 8% and slightly over 8%. Now, with respect to equity, a couple of traded BDCs completed follow-on equity offerings I guess it was a couple months ago, which was remarkable considering the volatility in the market. And many other BDCs continue to keep equity ATM programs active where they can opportunistically raise capital in the markets, assuming they're trading above NAV. By my last count, I think about 24 BDCs maintain active ATM programs and use them regularly. So all in all, I'd say in 2022, both from a credit performance and a capital raising standpoint, the strong year for BDCs.
How about your predictions for next year?
So market forecasts are definitely not my strong suit. I'm going to cheat a little bit. I'm going to borrow from a recent conversation I had with our friend Cliff Booth at Oppenheimer, who does a lot of deals in the BDC space, and also from conversations that we've had in general with many of our clients. With that, I am very optimistic for BDCs in 2023. Basically, what I've gathered is that while deal flow has definitely slowed and is getting more competitive, BDC pipelines are still robust. And so there's still interesting investment opportunities that BDCs are actively pursuing. And that's evidenced by the fact that we continue to see our clients actively try to raise capital, both into capital markets, but also through other structures such as joint ventures, which many BDCs have. In addition to that, many of our existing clients and frankly, new clients regularly still call about non-traded products, which I'm sure we're going to talk about a little bit later today. So there's still a lot of interest in private BDCs and non-traded BDCs. So notwithstanding the challenges that no doubt are ahead and the fears of a recession in 2023, I am optimistic. BDCs have historically been resilient products. Companies are always going to need capital. Investors are always going to want yield. So I think that bodes well for BDCs in 2023 and beyond.
Thanks, Payam.
So, Owen, as Payam just mentioned, we've seen non-traded BDCs grow increasingly popular in the past few years, and that the structure continues to evolve. The model of the non-traded BDCs has largely moved away from having the 5 to 7 year period before undertaking some sort of liquidity event to much more of a perpetual life vehicle. How does this impact the markets for non-traded BDCs?
Yeah, there's been a tremendous shift over the last number of years. The old model, as you mentioned, for non-traded BDCs really followed the model for non-traded REITs, and there was always high commissions, high fees, lots of fees, at least in the REIT space, and a limited period of 5 to 7 years where you would offer, and then at some point in time after that there'd be a liquidity event. And during the life of the offering, prior to the liquidity event, there wouldn't be very much liquidity. And so what we've seen is the space. It's right now it's a NAV BDC, which follows the NAV REIT. So there's the upfront commissions are not the way they used to be. Most of these products are not really sold through the broker dealer channel. To the extent that they are, the upfront commissions are much lower. In most cases, they're sold through the RIAs or the wirehouses, in which case the commissions that are being paid upfront are not even being paid to the dealer manager; they're being paid to the RIAs or whoever the other the RIAs or through the wirehouses. So what we've seen also is lower fees across the board. You don't see 2 and 20. You don't see 2% management fee, 20% incentive fees. You see more liquidity, and and this has led to all sorts of new sponsors in the market that would never have touched this product in the past. When you hear that, you would think that the states have spent years talking about how much they don't like the non-traded structure, they don't like the high upfront fees and everything else. And with all the advancements that have happened, you would think that the states would have evolved a little bit more than they have with these products, or maybe come to appreciate them a little bit more, but we're not seeing that. I think the states have been very slow to adapt. They still view this as a very risky product. They don't believe the liquidity is really there, and the same sort of comments that they've issued in the past, the same issues they've had, have really not changed, even though the structure has changed quite a bit.
So you mentioned the states and their review process, which most folks know can take quite a while. What are some of the options that the sponsors have to deal with this?
Yeah, so one of the biggest issues that the states raise is they impose concentration limits or different states will have different concentration limits for these products. And it's not a uniform. I think for a long time, the states have wanted to, or NASA has wanted to have some sort of a uniform concentration limit across the board. That's never happened. There's always been pushback, and frankly, they haven't really been able to come up with a uniform standard that makes sense and captures the things that they want to capture. So you see different concentration standards that the states are imposing, and because of the distribution model now, the platforms or the wirehouses, they'll take the most restrictive concentration limit and they'll oppose that across the board to all investors. And so for a lot of folks, you know, that's really, it's way more restricted than it otherwise would be. And so they're viewing different options, or they're thinking about different options. And we've seen some products in the market, you know, from really, you know, large global institutional managers that look a lot like a non-traded BDC, but are actually being sold privately. They're only, you know, being sold to accredited investors, and you know, they're otherwise the product looks the same. The one big hitch right now that hasn't been worked out is that you know, if you want to do a private BDC and you want to have multiple share classes to reflect the different distribution channels, the SEC has not provided they have not provided exemptive relief for private BDCs to do that. There have been a number of applications, or there are a number of applications that are pending. And I think when you look back at how long it took non-traded BDCs to get relief in the first place, I think it was 6 years. You know, hopefully that's not what we're looking at for private BDCs. I think to a large extent, it's a very similar issues than what non-traded BDCs had. But in any event, I think those applications have been outstanding for over a year now, maybe a year and a half. And, you know, hopefully there'll be progress on that front. But that's one way. That's one option is to bypass the public offering entirely and you know, and just offer privately.
So I mean, this market this year has really been the story of the non-traded, and some of the larger BDCs have really raised the money in that area. How big could this market get?
You know, that's a great question. I think it's a great question, not just with the amount of capital, because that's one part of it. Then the other part is how many sponsors. There are a lot of sponsors that have filed for non-traded BDCs. I think the amount of capital that's been raised has gone through the roof in the last year or two, and that's with a number of these big institutional players that have not yet launched. So, you know, if everybody is successful, it's going to be an extremely large market. That remains to be seen whether or not whether they can all be competitive. You know, we're starting to see a little bit of growing pains right now, maybe on the REIT side. And keep in mind, the REITs have they have a different structure. They have what you call like a redemption program, where instead of you know, offering to repurchase a specific number of shares, they have an ongoing redemption program, and they cap those from quarter to quarter. But if there's excess demand for liquidity, those roll over to the next quarter. And so they've had to. There are a couple of the really large non-traded REITs that have had to gate redemptions in the last quarter, and there's been a lot of press about this. It's not quite the same issue for BDCs, because when they do a tender offer, they're seeking to, you know, repurchase a specific number of shares, and that can't change. But at the same time, you know, if we see more demand for liquidity through the tender offers, you know, it will be interesting to see the effect that has on capital raising.
Great. Steve?
Kristen, private BDCs remain a very popular option as well. What do you think we're going to see for private BDCs in the years to come?
I think that we will see that private BDCs remain an incredibly popular option. On a very high level, just to recap, we use the term private BDCs to refer to all BDCs that are not conducting any sort of public equity offering. So they're offering shares through a private placement, and generally, but not always, they have a drawdown capital structure. We usually consider the main advantage of a private BDC to be this drawdown structure and also the potentially shorter process with fewer regulatory filings. The process is shorter because the Form 10, which is the main SEC filing in the structure, can be effective in as little as 60 days, and the shares aren't registered on an exchange. In addition, as Owen just talked about, there's no blue sky registration requirement like you would need in the non-traded space. And so this also shortens the time period. The drawdown or capital call structure is also an advantage because it eliminates cash drag by allowing funds to only be drawn as investment opportunities arise. And this is pretty much always an advantage, but it's especially favorable in uncertain economic times or when your investment pipeline is not clear. I also think that we will continue to see private BDCs used for two main reasons. The first is as a permanently private vehicle or as a private BDC that does not contemplate a liquidity event. Permanent in this instance is a bit of a misnomer because unlike the permanent or perpetual non-traded BDCs that we were talking about, in these structures, there is almost always an end date. There's just not an obligation to conduct a liquidity event. So instead, the private BDC is obligated to wind down after a set period of time, subject to certain extensions. And the structure basically combines the advantage of a traditional private fund with the transparency and oversight of an SEC registered fund, and then also the tax and structuring advantages of the BDC RIC structure. Most recently, we've seen some of these permanently private BDCs structured as Delaware entities, which can eliminate the need for annual shareholder meetings and proxy solicitations. So I would expect that this will continue to be a popular choice. And we're also going to see some of the older or original vintage permanent private BDCs start reaching the end of their term. So they'll have to either liquidate or work to move their investors into a new private BDC vehicle. And then the other reason that we see private BDCs used, if they're not going to be permanently private, is as a stepping stone to a listed BDC. So the management team can raise money through the private BDC structure, build up an initial portfolio, and then either conduct an IPO, which now doesn't have to be blind pool, or merge the private BDC into an existing public BDC. But we are hopeful that maybe in the next year, we'll see our first multi-class BDC. As we've already mentioned, non-traded BDCs have exemptive relief to offer multiple classes of common stock with varying sales loads and distribution fees. And if this relief were extended to private BDCs, it would open the private BDC structure up to a wider investor base, allow it to be offered to additional distribution channels, or potentially just serve as a stepping stone to a non-traded BDC.
Cynthia?
Well, while we were focusing on the structures and what people have been opportunistically using this past year, talk a little bit more about the rulemaking and some of the rulemaking that affects registered investment companies, which sometimes affects BDCs and other times don't. But Cindy, could you talk a little bit about that?
Sure. Yeah, no, I'd like to, I guess, briefly mention two important rule adoptions and two proposed rules that are likely to receive significant attention in the coming year. The first adoption is the amendments to Form NPX, and this applies to registered investment companies, including registered closed-end funds. It does not apply to BDCs, and the amendments don't change that. I know that Kristen will briefly mention a little bit later how these changes may impact BDCs, but they will not need to be filed by BDCs. So the way that NPX works is it is the annual filing period for all funds runs from July 1st to June 30th. So the rule or the form changes will impact any votes that happen starting on July 1st of 2023, and will then be in the document that's filed in the summer of 2024, so covering the period ending of June 30th, 2024. Just to briefly highlight some, what these changes are. In the disclosure in the MPX, we'll need to track the language in the order of the proxy card. Votes will need to be categorized into one of 14 different categories. It's actually streamlined from what was in the initial proposal, which had a larger number of categories and also subcategories. So that's at least a bit of a win for the industry. There's also a requirement to disclose for funds that engage in securities lending. Those funds will need to disclose the number of shares that were loaned and not recalled, and therefore not voted. So this really does put some additional considerations that funds will need to make into their securities lending programs. And then lastly, the filing will need to be done in a structured data format, the XML, to allow it to be machine searchable. And so that's the first item that's been adopted. The second is only applies to the adoption, or the main adoption is the streamlined shareholder reports, and that only applies to mutual funds and ETFs. And it's going to require what the proposal has referred to as concise and visually engaging reports. The effective date for this rule is January 24th of next year. The compliance date is 18 months after that, so July 24th, 2024. I'm not going to go into too much detail about what this proposal will require, although we do have a legal alert on this if anyone is interested. But I think there's a few things that to touch on from the adopting release, both other parts of this that were adopted, and then also some items that were in the proposal that weren't adopted that may be of interest to for this audience. So two things that were specifically not adopted that the SEC said they need more time to consider. One was a prospectus delivery changes, so really fundamentally altering the way that disclosure is given to current shareholders of a mutual fund or ETF. The shareholder report was going to be used as sort of the updating document, and those funds would no longer deliver prospectuses to their current shareholders, meaning that you could be a current shareholder and purchase additional shares and not actually have your the current prospectus. That was not adopted, so that's not in effect. And the other change was certainly something that most on this call were probably paying attention to, which is a change to the fee table and the way that acquired fund fees and expenses would be disclosed in a footnote rather than the table itself. That was also not adopted. So two items that were adopted as part of the final rule. One is the rescission of mutual funds and ETFs to be able to rely on Rule 30E3, which is basically the notice and access for shareholder reports. So although this rule just went into effect not that long ago, once the effective date of this new shareholder report is in place, the mutual funds and ETFs will need to actually deliver this new streamlined, concise shareholder report and not be able to just simply post it online and deliver a notice. So closed-end funds will still be able to rely on 30E3, but really they're the only ones. And then there are also within this adopting release advertising amendments that are applicable to BDCs and to registered funds. And basically, I'll get summarizing it. If you show fee information, you need to have the maximum sales load or other non-recurring fees, and then also your total expenses without showing any fees and expense reimbursements. So that will go into effect again in the summer of 2024. And then just briefly touching on two proposals that I think will receive a lot of attention in the coming year. And one is actually not even an investment company one, but it's probably worth mentioning, which is the advisor outsourcing rule. The comments for that are due December 27th. And this would require a formalized due diligence, monitoring, and record keeping for advisors who outsource certain functions. A lot of the disclosure or discussion now about what is covered in this rule or what is intended to be covered. So I do think that there'll be a lot of attention paid to this in the coming months. And then the second proposal is it only applies to mutual funds, but I think it is going to, it already has actually taken a lot of attention from the industry, which is, and again, I'll briefly summarize it. It's amendments to the liquidity rules that really would fundamentally alter the way that mutual fund shares are sold. It would require swing pricing, in short, basically factoring in transaction costs into the prices that mutual fund shares were transacted at. So they wouldn't be done at NAV anymore, at NAV. And this, to say that this has received incredibly negative attention from the industry is not an understatement. And as of today, this still has not yet been published in the proposal has not yet been published in the Federal Register. So there's no end date yet for the comments, but there's already been a lot of press. And if you look in the SEC comment file, there have already been meetings with major industry participants with the SEC staff to presumably to oppose the rule, given what we've seen. So.
And the significance of going through these rules are they're still focused on pricing, fees, AFFE, that the types of things that are being considered for other investment companies usually work their way into the BDCs in some way. So it's being cognizant of that, I think, is very important. Steve?
Thanks, Cynthia. Thank you, Cindy. So Stephanie, in recent years, there have been interest in BDCs entering into joint ventures to increase portfolio yields. Why would a BDC consider JV financing, and what are your predictions for JV financing in 2023?
Sure, thanks, Steve. The interest really goes to driving returns and the use of leverage for BDCs. If a joint venture, and there's probably 40 or so out there now, in order for a joint venture to work for a BDC, it needs to be unconsolidated with the BDC. So it is a separate subsidiary of the BDC that is also owned and jointly controlled by a third party. If you're able to get your accountants to sign off on the fact that the JV is unconsolidated, where that is helpful to BDCs is that then the leverage that is incurred to drive returns in that JV and then indirectly up through the BDC is not consolidated. So you don't have to worry about the leverage at the joint venture to be part of the BDC's asset coverage. The key factor there, and for those of you participating here that have talked to any of us about JVs, we harp on this all the time. It's really mutual assured destruction. It's making sure that both in practice and on paper, the JV is jointly controlled, meaning the investment decisions are made by both the BDC as well as the unaffiliated third party. That means if you're voting, you have an investment committee for the JV, you're voting on each individual investment, and it's a vote of 1-to-1. Each party has a veto power with respect to the investments. So, there are other details there, obviously, but I think that's the one you hear probably from our team up here from us the most. As far as what we're going to see and what the predictions are for 2023, I think we're going to continue to see a proliferation of these JVs. I think the volatility in the market to raise capital has definitely impacted the structure and the willingness and the desire to enter into these JV transactions. Payam talked a little bit earlier about the markets and what we're seeing in the markets, and certainly with equity capital, not as much as we're seeing on the debt side here recently. And the JVs are a way to increase those returns by incurring more leverage that doesn't count against the BDC. So I think we will continue to see JVs. It's interesting, obviously they've been around for a while. We've started to get a few more questions and see some JVs start to wind down in the normal course, but I wouldn't say that's a matter of they're losing the desirability to enter into them, but rather normal course. Sometimes these things just run their course. Your third party wants out, your third party is looking for a fresh start, and sometimes these have terms, etc. So, while we will see, I think, some wind down, I think we'll see many more BDCs enter into them when they can find a good partner.
And Stephanie, just with the result of the markets we've been living through and some of the wild swings and everything, I think a number of folks have been looking at kind of repurchase programs and 10b5-1 programs. Maybe you can update us on where we are from that perspective.
Sure. Yeah, we've definitely seen an uptick in repurchase programs. I think the key to remember with your repurchase programs, and we all see this in the market where BDCs will enter into them, the board will adopt them and approve them, typically for a 1-year period, a certain number of shares, dollar amount, what have you. That doesn't necessarily mean that the BDCs are acting on them. I think oftentimes BDCs want to put, and management teams want to put them in place to the extent they need them to aid in their managing of the market volatility. So I think sometimes we see BDCs, they'll enter into these programs, they'll start repurchases initially and then dial it back, and it'll come and go. And so from quarter to quarter, you'll see different results from different BDCs on the repurchase programs. Cynthia, you mentioned the 10b5 plans, and a lot of times the way BDCs implement repurchase programs, to the extent they do, is through a 10b5-1 plan. And as just a quick reminder, a 10b5-1 plan is basically a plan for the BDC, although officers and directors enter into them too, is a way to put a plan in place without triggering or impacting your insider trading policies and procedures and your insider trading windows. So the plan is put into place when there is no material non-public information that is known either by the company or if it's an officer director plan. It's put into place at that time, and then it runs automatically. It's really just there to have, whoever's administering the plan for you, they have their parameters and it's run, and there's no more decision making during the period of the plan. So you could still be repurchasing in a closed window period, but without market manipulation, because you entered into the plan and you made the investment decision during an open window period. Now, as many of you know, we did put a legal alert out on this. The SEC proposed rules a while back regarding 10b1 plans. The idea there is really to, keep them, the SEC understands the importance of these plans, but put a few more parameters, a few more guardrails around them. A lot of plans operate with a cooling off period. So you enter into the 10b5-1 plan, you take 30 days or so to cool off, and then the plan is implemented. The SEC is proposing, and I believe they're voting this week, maybe even today, on the proposed rules. They're proposing mandatory cooling off periods, 120 days for management, 30 days for issuers. Also note this impacts 10% holders as well, so your larger shareholders. Mandatory certifications by officers, again, really guardrails around these plans. A box to check in your Form 4s and 5s, which I know everybody's very excited about. And then new disclosure about the plans in your 10Ks, your 10Qs, to give the investors the more disclosure and more information about how these plans are being operated by issuers. The disclosure covers the basic adoption of a plan, termination, amendments of a plan, more disclosure about your insider trading policies, so shareholders have better insight into how the company is thinking about repurchases when they're using these plans for repurchases, but also how the company is, and directors and officers generally, are thinking about these plans and their participation in the market for a company stock.
Isn't there also a proposal out there on repurchase programs as well?
Oh, right. Thanks, Cynthia. Yeah, the SEC put a proposal out on repurchase programs. And again, it went to kind of disclosure and how they're operated a while back. But in light of recent legislation that impacts the tax impact of these plans, the SEC, October, I guess we're in December now, so not last month, the SEC reposted those proposed rules for public comment And they also put out a memorandum on the tax impacts, describing, basically giving the community an idea of what this new legislation does to their proposed rules, and giving some guidance on things that they want the industry to be thinking about. I'll note that the new rules really don't impact BDCs, but it could impact how these proposed rules are adopted, which then impact BDCs.
Right. The tax piece of it, the SEC piece.
Yes, sorry. Yeah.
The SEC piece probably will, and there's gonna be a comment period for people to put more comment letters in. But Steve?
Thanks, Cynthia. Thank you, Stephanie. This year, the 18-month transition period for the SEC's valuation rule ended, which, among other things, allowed BDCs to designate their investment advisors, or in the case of internally managed BDCs, an officer, as the valuation designee for purposes of valuing assets for which market quotations are not readily available. In many ways, the rule appears to be a recognition of how funds have handled valuation in practice in the past. In your experience, Dwayne, are most funds appointing valuation designees? And if so, has that reduced the workload on boards?
Hi, Steve. Yes, most funds have appointed valuation designees, but that has not necessarily immediately reduced the work that boards are doing on valuation. And this, to me, is to be expected. So previously, boards were getting detailed information about valuation, about specific names, and about the values assigned to those names because they were determining the value. Now, boards who have appointed a valuation designee will be moving more into an oversight role. So with this, boards have to set up an infrastructure to oversee the valuation designee. While they are doing this, we have found that most boards, while they're setting up their infrastructure, they continue to receive the information that they received before. They continue to meet with the third-party valuation experts and do all of those things. So while they're figuring out how to effectively oversee the valuation designee, they're continuing to do the same, a lot of the same functions that they have done before, other than specifically determining the value under the 40 Act.
Well, a follow-up question. You mentioned that most boards have appointed a designee, which means that some have not. Why would a board decline to appoint a designee?
There are a lot of potential reasons why a board could decline to appoint a designee, but the reason that we found that is most likely is that they can't meet the requirements of the rule. So the valuation rule requires a valuation designee to effectively segregate the valuation determination function from the portfolio management function, which means that portfolio managers can't determine or significantly influence the value assigned to any assets. So for companies that have a leanly staffed management, or where management wears a bunch of different hats, that can be difficult to segregate that out. For other companies, they maybe decided that they want to have their portfolio managers involved in the valuation process and use the board as a check on that process, similar to the way that it's been happening in the past. So a lot of it is due to the structure of the rule, which is concerned a lot with making sure that there are limited conflicts of interest when determining the value. Those are the reasons why we've seen that a board wouldn't appoint a valuation designee.
Okay, well, let me ask you this. Since many of the senior executives sit on an advisor's investment committee, how have companies dealt with the segregation which the rule seems to require?
So the rule is a principles-based rule. So there's no one way of complying with the rule for segregation. So what some companies have done is that they form valuation committees or subcommittees that determine the value of the assets, and portfolio managers can participate on those committees, but maybe they don't have a voting a vote on those committees. Another way to do it is that portfolio managers might be involved earlier in the process when determining, when sort of talking about the rough values, but they aren't involved later in the process. And some companies may rely more heavily on third-party valuation experts, and then use a price challenge process when needed to challenge those prices or to get to a price that they think is more accurate. So there are a lot of different ways to handle that. But the main thing to remember is that a board and the valuation designee should be thinking about conflicts of interest and trying to minimize those conflicts of interest, because at the end of the day, the SEC has not provided a specific way to do this. And what that means is companies have to make a judgment call about the level of risk and the level of potential conflicts of interest that their process provides.
All right, Dwayne, one more question, and I'll stop beating you up. The derivatives rule became effective this year. Do you see any major impacts on BDCs?
Not really, and the reason why is because the derivatives rule has a carve out for limited derivatives users, which means that your derivatives exposure is basically less than 10% or less. And so when you are a limited derivatives user, the only real requirement is that you adopt a derivatives policy. And a lot of BDCs have done that and without question. So that has been fairly straightforward. The difficult part has been when BDCs use derivatives when they're either ramping up or winding down, because the rules are very they are quantitative. And so once you pass a specific threshold, then you're either in the rule or you're out of the rule. And so the SEC maybe didn't consider what happened when a BDC is starting up or winding down or a closed-end fund. And so we've seen that people have had challenges when trying to use derivatives in those contexts, and there isn't a real answer for what to do yet. So that is something that people might want to take up with the SEC if that becomes an issue for them.
Thanks, Dwayne. Cynthia?
Sure. In November, the SEC adopted new rules to enhance proxy voting disclosures. Kristen, what impact is that going to have on the BDC community? And what are some of the other recent trends as people prepare for their annual meetings coming up for 2023?
So one of the rules adopted this fall is the universal proxy rule, which requires the use of a universal proxy card in contested director elections. And it also, so that requires all duly nominated directors to be listed on the same proxy card and allows shareholders voting by proxy or in person at a meeting, the same voting options. These rules are not yet applicable to BDCs, but to the extent that we see contested director elections, I would expect that BDCs may look to these rules for guidance. And then in addition, as Cindy mentioned, in November, the SEC adopted amendments to Form NPX that are only applicable to mutual funds, ETFs, and certain other registered funds. So BDCs are not currently required to file a Form NPX, and the new rules do not change this. But they will require certain investment managers that are required to file Form 13F, to file a Form NPX if they vote proxies on certain matters relating to executive compensation. And I think in general, these rules could result in additional disclosures being available about how BDCs and their advisors vote equity securities that they're invested in. And I think that these revisions underscored a continued increased focus by both the SEC and investors on advisory duties relating to voting and also on environmental, social, and governance or ESG issues. And I think that we're going to see this as a trend in this year's proxies. It's likely that BDCs are going to increasingly use proxy statements as a platform to give an overview of their view on various ESG issues and how those issues inform their investing. Beyond that, I think that in general, we'll see new formatting and increased use of graphics and different ways to present materials that will focus shareholders on ESG and other important issues, including board and management diversity and skills.
And are companies required to file annual reports? They suspended the annual reports that used to be filed, the glossy versions of those, you used to you have to submit those to the SEC. I think that those are now required to be filed in this new retail environment.
I think you're right. Yes.
And then there's also some changes that are coming through on shareholder proposals. This is an area that I think you're going to see a lot more rulemaking. There's been some back and forth in rulemaking as well with what ISS has to report to companies. So I would definitely focus on this area. Steve?
Thanks, Cynthia. Thanks, Kristen. In 2020, the SEC provided temporary co-investment relief to allow BDCs to invest alongside certain affiliates in a manner that was previously prohibited. This temporary relief has since expired, and many BDCs are filing exemptive applications for amendments to prior co-investment orders to make this relief permanent. Anne, can you explain this process and what you think lies ahead?
Sure, I'd be happy to, Steve. We actually previewed this development at our BDC Roundtable earlier this year in March, because at that point, the temporary relief was about to expire and we were waiting to see what would happen. As of the Roundtable, we had just learned that the temporary relief was going to expire, but that BDCs with co-investment orders could file applications to amend their co-investment orders to make the temporary relief permanent for them. At that point, at the Roundtable, we were making predictions for how this process would work because we had never seen this before. Now that we're at the end of the year, we can look back and see how the process actually worked out. But first, just a quick background on why the temporary co-investment relief was necessary. Under the original co-investment relief, a BDC and a private fund could only participate in a follow-on investment, which is providing additional capital to an issuer, if the BDC and the private fund had participated in an initial co-investment transaction in the issuer. This could be a problem because private funds, as we all know, have finite lives. So for example, if a BDC and private fund 1 participated in an initial co-investment transaction in an issuer, and then private fund 1 winds down and private fund 2 starts up, then the issuer comes back and asks for more capital. At that point, the BDC and private fund 2 would be prohibited from participating in a follow-on investment together. That leaves the BDC with two options. It has to tell the issuer, sorry, we can't provide you the capital you're requesting, or because they can't do it on their own, or the BDC has to fulfill the request on its own, and that may mean that the BDC is investing more than what would be appropriate for the BDC. Neither of those results are good. And this has always been a problem even before COVID hit, and we had talked about it with the staff, but we had never seen any movement. Then when COVID hit, it finally became apparent that smaller businesses really did need more access to capital. And the staff granted a temporary exemptive order that, among other things, allowed BDCs with co-investment orders to participate in follow-on investments with private funds that did not have an investment in the issuer. As Steve mentioned, the order was granted in April 2020, and it was effectively amended twice and finally set to expire at the end of March of this year. And so that brings us back to where we were at the Roundtable, waiting to see what would happen. And the SEC let us know that the temporary relief would in fact expire, but that BDCs could apply for an amended order. The amended order would solely address the definition of follow-on investment to correct this issue. The thought behind this plan to use an amended order as opposed to everyone filing brand new applications was that an amended order would be shorter and could be processed by the staff more efficiently. And of course, that would be very important because every single BDC that has a co-investment order could be applying for this new relief. And the staff worked quickly to come up with a form for this new application. And there are a few different variations out there as precedent now. In general, the application to an amended order is short and relatively straightforward. There was one exception to that. As probably everyone knows, every time you file an application with the SEC, you have to list all funds that are going to rely on the relief in the application and get EDGAR codes for them. Well, some platforms received their original co-investment order years ago and have formed over 100 new funds since then. So they had to obtain EDGAR codes for all of those new funds. And when this process came out at the end of March, all the platforms were applying for relief at the same time, and everyone had to get new EDGAR codes. So for a while, the EDGAR office was inundated, but everyone did get their codes and the process started working. And the first amended order was granted on June 7th, 2022. And since then, about 16 amended orders have been granted, and our firm has worked on over half of those. And 2 more notices were issued last week, so this is still very much an ongoing process. And there are 2 points I want to note. I just want to reiterate that this relief only applies to private funds. So a BDC or registered investment company still can only participate in a follow-on investment if they acquire their interest in the issuer in an initial co-investment transaction. And secondly, I've been referencing BDCs this whole time, but registered investment companies are treated the same as BDCs under co-investment orders. So the same analysis would apply to registered investment companies. And as far as what lies ahead, at this point, the application to amend an order is relatively straightforward. You just have to follow precedent. And BDCs that don't have an order or are applying for a brand new order and need a full application for some reason, they can use the new definition of a follow-on investment and get the same benefit. So this has been an incredibly helpful development for the BDC industry this year. It permanently allows BDCs to gain access to the additional capital that is available when new private funds are formed.
Thanks, Anne. Cynthia?
Sure. So we started off talking about rules, and so now we'll talk a little bit more broadly. As we know, Chairman Gensler has a very ambitious rulemaking agenda. I would say a torrid pace during his tenure, from cyber to ESG. The agenda really runs the gamut. Cindy, what SEC rules should BDCs be looking for, and which ones do you think are going to get through?
So I guess I've been given the task of reading the crystal ball here, which, again, the SEC's last published regulatory flexibility agenda was in June. So there, that's the last we have to go off of in terms of their priorities for proposing and adopting rules. As we've discussed here, as I'm sure everyone has seen in the press, a lot of these rules have received a lot of fairly negative feedback, including from some of the commissioners. I mean, if you look at the votes of the rules that have been passed, a lot of them have been along party lines. So it is very political and divisive. A couple of rules that I would expect to see adopted in the coming year, if I'm wrong, we'll see. I do think that some version of the funds names rule will probably be adopted. There has been negative feedback on that, including just last week, the ICI General Counsel published an opinion piece in the Financial Times, encouraging the SEC to abandon the proposal. Just briefly, the funds names rule is what we refer to as Rule 35D1. The current version of the rule requires that if a fund is invested in a type of investment, it really needs an 80% test to invest in that type of investment. So, a large cap growth fund has to invest 80% in equity securities. You notice I didn't say the word growth there, which is part of the proposal that is, particularly receiving a lot of negative feedback, including the words like growth and value, which in this 80% test, as you can imagine, those are pretty subjective. Each investment advisor and each index even has a different definition of what that means. And so that's a part of the rule that I think certainly the industry hopes won't be adopted. Another part that is, again, very controversial is currently most funds that have names rule tests say that they'll be invested in this type of security, under normal market conditions. The proposal would require sort of a mandatory getting back into compliance period, which of 30 days, which could lead to funds needing to sell off holdings that the advisor would otherwise believe is a good investment, but because again, I think the classic example is a small cap fund that where some of the investments have appreciated and are no longer within the definition of small cap could be forced to be sold in a fire sale to come into compliance with the rule. So that's another sort of controversial aspect of the rule. Again, ESG is not currently part of the rule right now, but that being said, if you are trying to get a new fund through the SEC through disclosure review, they are applying this rule. You can't launch a new fund that has an ESG name without having 80% test. So in effect, that is kind of already in place through disclosure review process, but that obviously isn't applying to funds that are currently in effect. And one aspect of this proposal that I think, those on this call will probably want to pay particular attention to is a specific application to non-traded funds, non-traded closed-end funds and BDCs, whereby they would be required to make this test a fundamental policy, meaning that you couldn't change your 80% test without a shareholder vote. It's obviously not a great result. I would imagine that if this passes and that version of the rule passes, that some funds would think about whether or not they want to change their name before the end of the compliance period to not have that to not be subject to that. So again, all this remains to be seen. It's hard to think that some version of this rule wouldn't be passed, but we'll see. Another proposal that's comment period has, I guess, long since closed is the cybersecurity for investment advisors, investment companies, and BDCs. And again, just in brief, the idea there is sort of a written compliance policies and procedure to address cybersecurity risk. Similar, I think of it as sort of a similar version to a derivatives risk management program or a 30-day one compliance program, but targeted at a different type of risk and additional reporting and record keeping. I think that probably some version of that will get adopted. That's maybe less controversial than certainly any of the ESG proposals that are out there. So those are my crystal ball thinking.
All right, well, and I can't let you get away without asking you about AFFE. Any idea about when that might pass? For BDCs specifically, or?
Well, I mean, as I noted earlier, right, the tiny, I don't know if I'd call it a fix, but the small fix to not have to have mutual funds include that amount in their fee table was not adopted along with the rest of the proposal. Yeah, I don't know. I mean, I think there's such, it seems like such a small issue for when there's so many other issues going on that I don't know. It seems like it shouldn't be particularly controversial, but we'll see.
I mean, I think the one takeaway we can make is that the Gensler does know about it because when he was asked about it during a particular hearing, he answered that he was well aware of it and that and the staff was working on it. I do think there's timelines are kind of as far as knowing exactly when it's going to happen are kind of off the table, but that I would expect, hopefully not in kind of any longer period, but that it will be dealt with at some point because there has been a lot of discussions with the staff, and it's just it might get tucked into something else. And you just never know. But just so as you are aware, a couple of people have mentioned that we have legal alerts on a lot of these topics. There's going to be a lot of activity. I think you'll see a lot of activity by Congress as well in the upcoming year. So hopefully this has been helpful to look into kind of the crystal ball, as Cindy said, for 2023. And Steve, you want to take us home?
Yeah, well, thank you, Cindy, and thanks to all of our speakers. Thank you, Cynthia. And we'd like to thank everybody for participating. As always, if you have any questions about any of the topics we discussed, please don't hesitate to reach out to any of our speakers. Wishing you all and your families a healthy and happy holiday season, and we hope to see everyone at our roundtable in the spring. Thank you.